Just a second.
So my name is Muskan Agrawal and my team members are Riya Arora, Rosni Sachdeva and Juhi Loya. We are from the Deal Makers and today we are here to give a presentation on derivatives. So next slide please. So now we will see table of content or what are the things that we will see in this presentation. So first is introduction. Second is types of derivatives. In this we will see meaning, characteristics, example of different type of derivatives. Third, comparison table. In this we will compare all different three type of all different four type of derivatives. And last is key takeaways. Next slide please. So, first let's start with the introduction. So, first we will see what is the meaning of derivative. So, derivative is the financial instrument whose value depends upon or derived from any other asset. That assets are commonly known as underlying assets. Some of the common underlying assets are stock, bond, currency, interest rates, etc. So, now we will see what are the purpose of derivatives. So first is hedging. Hedging is kind of an insurance which is used by investor to minimize their risk in future. Second, second is speculation. Speculation means earning profit from predicting current market and future market. Third is arbitrage. It means buying and selling in one market and selling in another market and making profit from the price differences. So, now we will see a small example. So, suppose there is a farmer who grow wheat. He is in worry that the price of wheat may fall till the time of harvest. So, and on the other side, there was a bread company who don't want to pay any extra amount in future for their raw material, that is wheat. So, they both came into a contact that we can say derivatives, and they fix the price of a wheat that will be sold in future. So, next slide, please. So, now we will see different types of derivatives, and they are forward contracts, future contracts, options, and swaps. So, now I would like Ria to continue.
Okay. So now we'll see what are forward contracts. These are simple agreements between two parties which have came together to buy or sell an asset for a future date for a price agreed upon today. These are private customized contract and are traded over the counter, which means that uh, they are not traded on a formal exchange. The key features of these contracts are that there is no initial payment required and the settlements happen only at the maturity date. The characteristic of these contracts are that they are customized and they are not standardized. Also, they are traded over the counter and they have high counterparty risk, which means that they are not regulated by a formal authority. Now, let us understand this better with an example. Imagine a textile exporter in India who is expecting to receive US dollars in 3 months, after 3 months. To avoid the currency fluctuation risk, the exporter enters into a forward contract with a bank with a fixed rate of US dollar at today's price. Now, after 3 months, he'll receive the price which is decided today. This locks the exchange rate and protects the profit. Now we'll see the future contract, the second type of derivative. These contracts are quite similar to the forward contracts, but these are standardized and traded on an exchange to buy and sell a asset at a future date and price. The characteristic of these contracts are that they are traded on formal exchanges and they are regulated and standardized. Also, what makes these contracts unique is every contract has standard quality, quantity, and terms, and also the prices are adjusted through a process called market to market. Also, they require both the parties to maintain a margin for safety purpose. For example, an investor expecting gold prices to rise could buy future contract on MCX. MCX means multi commodity exchange. If the gold price goes up, the investor profits by selling those contracts at a higher price. Now, I would like Roshni to tell you about the option contracts.
Let's understand option contract. Option contract are the contract that gives you the right to buy or sell something at a fixed rate in future. In this, you are not obliged to do so. There are two types of option. First one is call option, that is right to buy. Second one is put option, that is right to sell. Now understand this with an example. Imagine you book a phone with rupees 50 which cost rupees 1000 for the next month. If the price of that phone goes up to 1200 rupees, you still get it for rupees 1000 and save rupees 200. But if the price drops to 900 rupees, you can skip the deal and bear a loss of rupees 50. That 50 rupees is the premium that you pay for the options. Now we will see the features of the option contract. First one is limited loss, that we have understand with an example that 50 rupees that we have lost is a bare minimum amount that we can bear. Second one is asymmetric payoff. That means potential profit is greater than the risk that we have to bear. Third one is leverage potential. If the price moves in our favor, we can get the maximum profit. Now we will see the swaps. Swaps is a deal where two parties agrees to exchange payment, usually interest and currency, currency over a period of time. It is used to manage risk of interest and currency differences. There are two types of swaps. First one is interest rate swap and second one is currency swap. Interest rate swap, in this two parties agrees to exchange interest payment on loan but in a same currency. Let's understand interest rate swap with an example. If a company A has a loan with fixed interest rate and company B has a loan with floating interest rate, now they will agree to swap their interest payment. Now A will pay floating interest to B and B will pay fixed interest to A. In this, principal stays with the original lender. Now we will see currency swap. In this, two parties agree to exchange principal and interest payment in different currency. For example, an Indian company borrows rupees 50 crore and US company borrows 6 millions, and they swap both the principal and interest payment to get the foreign currency they needed for their work without any currency differences. Now I would like Juhi to cover the next slide.
Um, Comparative summary table means key difference of forward contract. Customer agreement between two parties, no standard format or central exchange. High counterparty risks and no upfront payment. Second is future contract. Standard contract trade on exchange required margin money to safeguard defaults, lower risks due to regulation, cleaning house. And third is option. Provide rights but not an obligation to the buyer. Only the seller is obligated to fulfill the contract. Buyer pay a premium upfront. Swipes. Agreement to exchange cash flow. Example fixed for floating interest rate, private and customized contract, and similar to the forward in terms of risk and payment structure. Next slide. Key takeaways. Derivatives drive value for underlying assets and help manage financial risks are like stocks, bonds, currency, etc. are the primary used to manage a financial risk. Second is each derivative type has unique characteristics like risk profiles and use cases. Example is speculation, etc. And third is mastering this tool is essential for making informed financial decision, especially in risk management and portfolio strategy and corporate finance. Thank you.
Good job done, team
Deal makers.
deal makers. Yeah, Ria, Roshni, Muskan, and Juhi. Good job done. You will get the feedback in next session. We will have it. But presentation was good. People were knowing their subject. Everybody tried to explain it properly. And best part was nobody looked feeble here. Everybody was with confidence. So thank you. Keep learning.
Thank you.
Next.
Thank you.
Who is the next? Next group.
Sir, actually, I haven't got anyone
Sir, we
PPT.
are
Okay, Niket.
optimistic financial.
Okay, Niket, go ahead. Let me put a pin. Who all are there with you? You have to share your screen. I can give them a pin. Okay, Niket is well dressed as. Thank you, Niket. Good job. Are you in
Yes.
college or you are attending from home?
Sir, home, sir.
Wonderful. Your family is not, concerned about you. But good job.
Sir, yes.
Okay. Who all are there?
Niket, are you sharing your screen yourself or I have to do it?
Sir, am I visible?
You are
Yes,
visible.
share your screen. I have sent the
Ah,
PPT.
Ronak will share the screen, no?
I have sent the PPT in the group, unofficial investment banking.
Okay, you have sent it now. Okay.
You can share your screen or Ronak if you want.
Yes.
Next participant, whoever is presenting, please share your screen. Be ready with the sharing of the screen. Okay, optimistic vision. This is the new name, yeah? A merge group.
Yes, sir.
Okay,
Yes, sir.
good stuff. Go ahead.
Good afternoon, everyone. My name is Ronak Singh Thakur, and I am here representing the team Optimistic and the financial visionaries. Our topic is derivatives market, future forward and options. Okay. So our table of content is first we will give you introduction and what is derivatives. The second one is future derivatives. The third one, forward derivative, and at last, what is option derivative? For the introduction, so derivatives are used in the stock market to buy shares in a price where the deal was made before. Meaning you can buy shares at the same price even if the price has been raised in the future if you have made a deal before with the investors. Derivatives help us in gaining more profit with lesser risk. On the other hand, if the prices of a share falls, you can also cancel your contract, which will help you save your money and also help you in building capital, more capital. And next to Niket.
Good afternoon, sir. My name is Nikaja, and I'm here to explain common types of derivatives. So let's start from the future. Future contract is a standardized agreement traded on a stock exchange where two parties agree to buy or sell an asset, currency, and stock at a predetermined price on a specific future date. Because it is traded on a regulated exchange, it has standardized item, quantity, quality, and delivery date. Future are marked to market daily, meaning gains and losses are settled every day until the contract is completed. They are widely used for hedging against price fluctuation and also for speculative purposes. For example, an investor buy crude oil future if they believe that oil prices will going to rise. About the option, an option contract gives the holders the right buy, not the obligation to buy or sell an asset at a fixed price. The other name of option is the strike price. There are two types of option, call option and put option. The call option is about the right to buy, and the put option is about right to sell. The buyer pays a premium to the seller right for this right. If market conditions are favorable, the option is exercised. Otherwise, it expires worthless and false. It expires. Options are widely used for the hedging risk and speculative strategies. For example, a call option on a stock can help you make a profit on a high price, but it limited downside. Swaps. A swap is a private agreement between two parties to exchange cash flow based on different financial instruments. The most common type is an interest rate swaps, where one party pays a fixed interest rate and receives a floating rate, while the other does the opposite based on a notional principal amount. Swaps are over-the-counter (OTC) derivatives, meaning that they are not traded on exchange. They are used to exchange or manage risk, currency exchange, or commodity. For example, a company with a floating rate loan might enter a swap into convert it into a fixed rate loan if interest rates are expected to rise. About the forwards, forward contract is a customized agreement between two parties to buy or sell an asset, specific price at a different future date, not standardized and are traded also the over-the-counter OTC derivative, which means they carry a high counterparty risk. They are commonly used by companies and institutions to hedge against risk, like currency or commodity price fluctuation. For example, an exporter expecting USD payment in 3 months might enter into a forward contract to sell USD at a fixed rate, protecting against currency depreciation at a future date. From here, Pooja ma'am going to explain.
Good afternoon, everyone. I am Pooja Tiwari. I am going to explain different types of future derivatives. Let us shortly know about the future derivatives. Future derivatives are contract, buy or sell an asset at a future date at a pre-agreed price. There are mainly four types of future derivatives. First is stock future. Stock future is a future contracts where the underlying asset is a specified individual stock that like Reliance Industries stock, Apple Industries stock, and etc. Let us understand it by an example. Suppose you buy a Reliance future at a rupees of 2000 for a lot at 250 shares. Lot size of share is the 250 shares. Contract value is 2500 multiplied by 250, that is 6,25,000. Margin, let's say the 20%. 1,25,000 is the margin. If on expiry the stock is 2,600 rupees, profit would be around 25,000. Next is index future. Index future is that future contracts which is traded on the indexed value like Nifty 50, then Sensex. In that value which derivatives are traded, that is indexed future. Features of index future derivatives are cannot be settled by the delivery, settled in cash based on indexed value at expiry. Let us understand it by an example. Buy Nifty future at 22,000 with a lot share of 50. On the expiry, Nifty is 22,300. So profit would be around 22,000 minus 22, that is around 15,000. Next, third topic is the commodity future. Third type of the future derivatives is commodity future. Commodity future is a contract to buy or sell a specific quantity or a physical commodity like oil, gold, wheat, etc. And its advantages are hedging against price volatility in raw material, allow producers and consumer to lock in price. Let us understand this by an example. A jeweler expects gold price to rise. They buy a gold future at 60,000 per 10 gram. Contract size would be 1 kg is equal to 100 multiplied by 60,000. Amount will be the 60 lakh. Margin would be around 6 to 8 lakh. If price rises, then it goes around 62,000. Gain would be around 2,000 into 100, that is 2 lakh. Fourth would be the currency future. Currency future is the forex future, also known as contract to exchange a specific amount on one currency for another at a future date and predetermined exchange rate. Advantages of currency futures are protect against currency exchange rate risk, useful for businesses to engage in international trade. Let us understand by example. Imported for US dollar, US dollar and Indian currency may rise. Buy US dollar, buy Indian currency futures at rupees 83. On expiry, US dollar by Indian rupee is 85. Gain of rupees 2 into 1,000 multiplied by, that is the 2,000 per contract we have gained. So these are the advantage. Now I would like to call Pranay for further explanation.
Thank you. My topic is types of forward derivatives. First five types of forward derivatives: fixed price forward derivatives, a deal to exchange currency at a set rate on a specific future date. Second one is forward contract. Open forward contract. This is flexible date for currency exchange within a set period. The third one is window forward contract. Currency exchange can occur anytime within a chosen time window. The fourth one is non-derivable forward. No actual currency exchange. Cash is settled based on rate differences. The next topic will explain by Mohammad Ayan.
Good afternoon, sir. Sir, am I audible?
Yes, you are, Mohammed. Go ahead.
Thank you, Pranay. Let's look at three special types of forward contracts. The first one is flexible forwards. These allow you to pick the exact date for payment within a certain time frame. For example, imagine a farmer who doesn't know the exact harvest day but wants to lock in a price for selling crops sometime in the next 3 months. The second one is closed outright forwards. This is a fixed deal where both sides agrees upon the exchange rate and date now. For instance, a company knows it must pay a supplier $100,000 in 3 months and locks the rate today to avoid surprises. The third one is long dated forwards. These contracts last longer than usual, often more than a year. Say, a construction firm has a project finishing in 18 months and wants to secure the exchange rate for future payments. Each type helps depending on how certain you are about your payment dates and how far in the future your transaction happens. From here onwards, Bhumika will explain the next slides. Thank you so much, sir.
Good afternoon, sir. Am I audible?
Good afternoon. Yes, you are. Go ahead.
Yes. So let us begin by understanding what option derivatives are. An option derivative is a type of financial derivative that gives the buyer the right but not the obligation to buy or sell an underlying asset at a fixed rate called strike price. They are commonly used to manage risk or to earn profit or to speculate price movement in the market. So now let's understand the two main types of options. First is call option. A call option give you the right to buy or sell stock or any other asset at a fixed price before a certain date. You can buy a call option if you think the stock price will go up. If the stock price gets higher than the strike price, that is the fixed price, you can buy it more cheaper price and make it profit. For example, you buy a call option for Reliance stock with a strike price of 2,500 expiring in 1 month. And if the stock price rises from if the stock price rises 2,800, you can still buy it at 2,500 and earn a profit. An option. So next is put option. Put options give you the right to sell at a fixed price before a certain date. You can buy a put option if you think that the price will go down. If the stock price falls down, the strike price, that is the fixed price, you can sell it at a higher price and make it a profit. For example, you buy a put option of TCS company stock with a strike price of 3,000 rupees, and if the stock price drops from 3,000 to 2,700, and you can still sell it at 3,000 and make it a profit. So that's it. Now Anne will continue further.
Okay, thank you, Bhumika. So let's see what is volatility. Volatility simply means how much the price of an asset goes up or down over time. It shows the level of risk or uncertainty in the market. For example, if a stock moves from 100 to rupees 110 and then drops from 110 to rupees 90 quickly, it has high volatility. That is, the price changes quickly. But if it slowly changes to 102 or 98 rupees, the volatility is low. There are two types of volatility. The first one is historical volatility. It is like checking someone's past behavior. It looks at previous price movements. Second one is implied volatility. Implied volatility is like predicting how someone might react tomorrow. It's what the market expects to happen based on option prices for the future. So thank you so much, sir. That's my time.
Good job, done. What's your group name now? Optimistic Visionary, right?
Yes, sir.
Perfect, perfect. Good job, and I can see everybody was prepared. However, a team is as strong as its weakest link, which try to emphasize the fact that everybody should, contribute to the same level like the leader and others are contributing to it. So, optimistic visionary, be careful on that regard. Pranay, I am just highlighting the fact, first of all, your camera was moving, you were not stable, and also it felt like you are reading from the directly from your mobile or a laptop. Uh, while other might be doing it, but it was not obvious. Okay. So in the world where everything is happening virtually, please try to be stable when you are presenting. So right impression goes out there, right? So overall performance was really good, and you guys have captured the topic also quite well, no doubt. But one of the weakest link is bringing you down. So next time, do a mock run. That is the suggestion to our team optimistic, because your team is very big. So make sure that everybody is aligned with the same concept. Can we do that from the next time?
Yes,
Yes,
sir.
sir. We'll do it.
Okay,
Yes,
Yes,
sir.
sir.
Yes, sir. Sure, sir.
perfect. Good. Okay, next. Who is next? I can see there are three more groups, right?
Two more groups, sir.
Two more groups. Okay. So who are there? Can you just shout out their name? Are they there in the class today?
Yes, sir. The third group was upcoming investor with Brij Bhushan Singh, Bhumika Pamnani, Harsha Pateria, Nishu Singh.
And they are not there, isn't it? I can't see
Uh,
Pamnani.
yes, sir.
Okay.
Yes, sir. I can't see them either.
Okay.
And the fourth group was Team Imperium Capitals with Ayan Ahmed, Chandan Tandi, Varesh Shukla.
Okay. And they are not there as well, isn't it?
Yes, sir.
That's very good. Okay, so do one thing, presentation both group, post it in the group. Marking will happen only on the presentation which I have received. Yeah.
Yes, sir.
And there is a good news. There are two good news. One, two people internship has been extended, which is Ria Arora and Ayan Ahmed, even though he's doing a full-time somewhere, but he is working with us as a part-time. Dr. Dalvinder, this you need to inform your. We have extended his and Ria's internship, seeing their effort. Okay.
Yes, sir.
So
Yes, sir.
that is a very good news. And second, is the next batch we have selected 3 people who has shown keenness. In interview, one person has shown little bit of nervousness, but still we are considering her for the internship. So her internship will start from Monday. All 3 of yours, and the names are Mohammed Ayan. You have been selected, and there will be capstone project, and maybe out of these internship people, we will take 1 or 2% on the full-time job. Okay, might not be a $1 million job like you might be getting in the market, but it can be work from home job if you keep performing the way you are doing. Yeah. And like we have offered to IIM teams as well, you can keep continuing contributing for next 3 to 6 months more. Yeah. And same thing will be converted before you pass out or go to second year, a full-time work from home job. Make sense? So 8
Yes, sir.
people we
Thank you.
have now, and out of that now 3 + 2, 5 people is going to continue for next 1 month, and then we will open again for next 5 people. So thank you, all of you. Congratulations. Who are there? I think Ayan is there as well, right?
Yes, sir. I'm here.
Thank you so much, sir.
Thank you, Ayan, for working hard, even though you are doing full-time field job. Yeah, and Ria
Thank you.
is exceptionally well. She is doing and contributing to the team too.
Thank you, sir.
And welcome. Where is Bhumika? Bhumika. Okay.
Yes,
Yeah, Bhumika Asrani, I think, has been selected. She is there in the group.
thank you, sir.
Okay, and then we have the second person, Mohammed Ayan. Mohammed Ayan, what's your situation with Bangalore stuff?
Sir, I got the message today that I have to join from Wednesday, sir.
This Wednesday,
Yes, sir.
and you are you are coming to Bangalore, right, to join that, correct?
Yes, sir.
Okay, perfect. So do come and meet us as well. Our job is anyway work from home, but
Yes,
what I will do, I will give you 1 week of breather. So you start with us, and then 1 week of breather to just check that how you are performing there, how tough the job is, like we did it for Ayan, right? Take a break of 1 week, and then we will, if you think you can still spend 2 different, internship, we will allow you. Yeah, that same thing what we have offered to Ayan. Fair?
yes, yes,
Okay. And when you are coming to Bangalore, do come and visit our office as well.
yes, sir. I'll definitely visit here.
Chalo, welcome. And any trouble you find in Bangalore, all of you, you can, if anybody is coming to Bangalore, my home is your home. You can always call me and take my guidance. Okay?
Thank you so much, sir.
Chalo, bye-bye. Take care. We will stop here. There is no point we continue. We have already covered module 5 now. We will jump to module 6 with a test. So prepare for the test, which will be happening in Wednesday. We'll have a Tuesday class, but we will have a test on Wednesday or Saturday. We will see that. Yeah, because there's still some portion of option and future. I will tell you with a story, so you will be able to remember that and able to at least do some calculations. So we will do it at Tuesday and Wednesday, some calculation and learning. And then Saturday, we will have the examination. Yeah, so prepare for that. Thank you very much.
Thank you,
Okay,
sir.
thank you, sir.
Take care.
Good day,
Thank
sir.
you, sir.
And all 3 of you, please report to your reporting manager, Shreya.
Okay,
Yes,
sir.
sir. Thank you,
Okay,
sir.
bye.
Thank you, sir.